All right. Hi, everyone. Thanks for coming. I think we're ready to get started here. My name is Matt Schwegman. I work with Compose Financial. We're a fee-only financial planner located right here in Fall Creek. And today we're going to talk about investing in a rising interest rate environment. First, some disclaimers. None of the information presented here is a recommendation by us because we don't know your personal information. We believe all this information we obtained is from reliable sources, but we don't guarantee its accuracy because information may be incomplete or condensed, and it's as of a certain date, so it could be different in the future. That's all right. Got some coffee? So next week, the Fed is going to meet on December 16th, and they are likely going to raise the target federal funds rate, which is likely to begin a slow process of small increases. They're not going to increase the rate, very, very steeply all at once. They've said they want to kind of gradually do it because they're still a little nervous about the economy, but this is a good sign generally that our economy is heading in the right direction. So we thought it would be a good idea to review the performance of 7 specific asset categories that have happened in the past 30 years. There have been 4 specific times when the rates have gone up. So we're going to look at how domestic stocks, bonds, foreign stocks and bonds, short and long-term bonds, and real estate performed over those 4 periods. And I think we'll show that it's still best to remain diversified. So the Chicago Board of Exchange says the likelihood of a Fed increase next week is at 87%, and that's up considerably since even a few weeks ago. Fed Chairman Janet Yellen has come out and said some very positive things about the economy and how she's ready to increase rates. So this is as of December 9th. It might even be higher. I haven't looked since Wednesday. So we have examined 4 separate periods where the federal funds target rate was increased at least 1.75%. It was increased one time by 4%, another time by 3%, another time by 1.75%, and another time by 4.25%. Now those increases would be similar to if this started a gradual increase here. Those were over time. Those were over like 2 years generally. So we're going to look at how those asset classes perform over these periods. And on the next slide, you can see the exact 4 periods we're analyzing. November 1986 to March 1989 was the farthest back one, and the most recent one was May 2004 to July 2006. The blue line, of course, is the federal funds rate. You can see that's been near zero since 2008 when the Great Recession happened. So we're going to go through we're not going to go through all 7 asset classes. We're just going to go through, the kind of the top ones that I picked out. But this graph example is going to show how our analysis works. So we used Morningstar research, and I found mutual funds that represent the 7 asset classes, and I wanted a time period of at least 30 years. Everyone in here has at least 2 of them have 29 years, the majority of them have 30 years. You'll see that in the appendix. But on the graphs that we'll show, we'll have 4 different graphs, each for each time period. The red line, the red dotted line, is the long-term performance over 30 years. So like over the 2-year period where they increased rates, if it had mirrored the long-term average, you can see on this chart it would have went from 0 to about 6.5%, what we would expect if it held true to the long-term average. Now the blue line is the actual performance of that asset class. So as you can tell on this particular graph, the blue line is below the long-term performance, so this would have performed poorly. And the gray kind of stepped up line in the middle is the actual target rate. That's the increase that happened over the time period, and that's on the right axis. The other 2 are on the left axis. The target rate increase is on the right axis. So first we'll look at domestic stocks, right? The most popular asset class. This is the S&P 500 essentially. So you can see that in the top left quadrant, the top left chart, we're gonna say that it underperforms. I mean, it started doing out really well, then dropped down below the red line and stayed below the red line. And if you look at all 4 of them, it underperformed in all 4. So our summary for domestic stocks is that there were 4 underperforming periods, but there were 0 negative periods. In each case, in each of the 4 time periods, domestic stocks still produced a positive return. The max return it could be expected, the max annual return was 9%. The minimum was 6.9%. Still a good return, obviously, right? 6.9%. And then the long-term return, kind of the average over the 30 years was 10%. So you can see during the time period, the average return was 8.2%, which is 82% of that long-term return. If we look at the proportionate return at the bottom, the actual performance was 8.2% versus a long-term performance of 10%. So it returned 82% of what you might expect. So because of that, because it had no negative return periods, we rated this as neutral, even though each period was underperforming. And the reason for that is, we still think you're getting 82% of what you expected. That's not terrible. It's still one of the highest performing asset classes comparatively to the other ones. So we're going to say neutral. It did not outperform its long-term average. Foreign stocks, you can see that the top two finished below the red line. However, in the most recent two periods, foreign stocks actually performed better. And this can kind of be expected, right? The Fed, when they're determining whether to raise rates, they're basing that primarily on the domestic economy. Foreign stocks are independent. They're not as dependent on what our Fed does. So as you can see on the summary here, you had 2 outperforming periods out of the 4, 2 negative returning periods. You can see that minimum annualized return was negative 14%. Now that's pretty bad. But however, this asset class in particular is very volatile. As you can see, your max return was 16%. So on average, this asset class returned 3.8% over the 4 periods versus its long-term average of 2%. So we conclude that generally this will outperform. Long-term bonds, these are very much dependent on interest rates. Long-term bonds are the most volatile of the bond classes in regards to interest rate fluctuations. So in each of these cases, long-term bonds perform very poorly. And you can see on the summary that you actually had a negative return period for bonds. Their average return was 2.7% versus their long-term average of 8%. This was the kind of the worst performing asset class, bottom two. This had a 33.9% proportionate return. So we conclude that this is an underperformed one. Short-term bonds performed relatively well. They did not perform as well as their long-term average, but you can see that blue line is pretty close to the red line in 3 of the 4 cases. Kind of the bottom right, the most recent one, it didn't perform very well. But in all the others, it kind of mirrors the red line almost. So the summary for short-term bonds is neutral. This analysis was pretty telling. I mean, it kind of holds true with what the common theory is in the industry, is that during a period of rising rates generally hurt bond performance. You should kind of shorten your duration. So you should move out of longer-term bonds. If your average portfolio is 10 years, you need to move maybe toward closer to 5 years in your portfolio. Short-term bonds are anything less than 4 to 7 years, whereas long-term bonds are 10 years plus. The last asset class we're going to look at is real estate. This is the worst performing asset class. This kind of makes sense too from a logic standpoint, right? As interest rates go up, housing gets more expensive. It's harder to get that mortgage. There's less demand to buy homes as a result. And what happens when demand lowers? Performance lowers, price lowers. So as you can see here, in only one instance did it outperform, and in the other 3, it severely underperformed. The blue line is way below the red line. So the summary for real estate is it had 2 negative return periods, and the minimum was negative 6.5%. That's pretty bad, especially for an asset class you expect to return over 10%, or around 10%. The long-term annualized return is 9.1%. So this is a very underperforming asset class. So here we're going to just show our summary, short and sweet. It's sorted by that proportionate return, the 5th column. As you can see, foreign stocks, as we said, perform the best, domestic stocks, and then bonds and real estate perform the worst. So our conclusions are that while certain asset classes may underperform, right, every one of these, if you look on the previous page, every one of the asset classes underperformed except one versus their long-term average. Foreign stocks were the only one that outperformed. Everyone else was less than their long-term average. So it still makes sense, even though they're underperformers, you're still getting a positive return. So you still want to diversify. Why do you want to diversify? Is this analysis looked at if rates consistently move upwards? That might not be the case. You might have a slight increase and then a war or something else might happen and you might go flat, or you might have another decrease. The Fed, the economy might show some signs of weakness, and they might think it's best to stimulate the economy again, driving down rates, which will obviously, if that happens, stocks would do bad and bonds would do better. So diversification is the key. It's better to focus on the two things that you know are going to hit your portfolio, which are fees and taxes. This next slide just shows a period where, what if the increase isn't sustained? You can see in the little red circle I provided here, it went up, but then it was flat. So you might have thought at first, we got another period of rising rates. But nope, it went flat and then it actually decreased.
May I hear the research now?
No, we're good.
Good?
Thank you. Any questions?
Explain the difference between the average actual annualized return versus the long-term annualized return.
Yeah, sorry, the actual return is the return over the time period we looked at. And the long-term average is how it performed over its life, over 30 years. So in almost every case except one, during the periods of rising rates, they underperform versus their long-term average. And you can see if you go to the after questions, there's going to be an appendix, and then there's going to be the mutual funds we actually used in the analysis. These are the mutual funds we used, and you can see the long-term. That's the figures on the right. The 30 are the years. That's the long-term average.